Example 4. Financial reporting, manipulation, motivations, and disciplinary mechanism. For each of the following two scenarios, identify factors that might motivate the company's manager to manipulate reported financial amounts, and applicable mechanism that could discipline financial reporting quality. Now, in our first example, ABC Company is a private company. Bank Anti-Big has made a loan to ABC Company. ABC is required to maintain a minimum 2 interest coverage ratio, that is EBIT upon interest expense. In its most recent financial reports, ABC reported earnings before interest and taxes to be 1200 and interest expense to be 600, so the interest coverage ratio is 2. In the report notes, the company discloses that it changed the estimated useful life of its property, plant and equipment during the year. Depreciation was approximately 150 lower as a result of this change in estimate. Now, if you are reporting depreciation $150 lower, then it means that your actual EBIT would have been $150 lower as well, because lower depreciation would actually increase EBIT. A higher depreciation would reduce EBIT, so the adjusted EBIT would actually be 1050. So we need to reduce 150, because if we increase our depreciation, EBIT would go down and interest expense would remain the same. So the adjusted EBIT is 1.75, that is lower than what that was required, that is 2. Now we also need to understand the motivation. Now the motivation to manipulate is that we need to maintain this ratio, that is interest coverage ratio of 2, and if we are unable to do so, there might be some repercussions or penalty. So this is one of the motivation. And again, we can see that the adjusted coverage ratio was coming 1.75. Now the potential disciplinary mechanism include the auditors who will assess the reasonableness of depreciable lives estimates. In addition, the lenders will carefully scrutinize. Now the lenders were Bank Anti-Big, so they also need to scrutinize that why come they are having this perfect interest coverage ratio. So why is that the case? So in addition, the lenders will carefully scrutinize the change in estimate, because the companies only barely achieved the minimum coverage ratio and would not have achieved the minimum without the change in accounting estimate. So they are just maintaining this coverage ratio and barely coming up with this number, and they have already done what they have changed some accounting estimate in order to achieve this. So they need to scrutinize further. Part 2. DEF company is publicly traded company. For the most recent quarter, the average of analyst forecast for earning per share was $2.5. In its quarterly earning announcement, DEF reported net income of 3.458 million. The number of common shares outstanding was 1.378 million. DEF main product is a hardware device that include a free 2-year service contract in the selling price. Based on management estimate, the company allocates a portion of revenue to the hardware device, which it recognizes immediately, and a portion of its service cost, which it defers and recognizes over the 2 years of the contract. Now over here, what's happening, that we are recognizing revenue earlier. So based on the disclosure, a higher percentage of revenue was allocated to hardware than in the past, with an estimated after-tax impact on net income of 27,000. So we are again recognizing this revenue sooner, and if we are recognizing this revenue sooner, so we need to do some adjustment. So this is our original net income. This is the number of shares we have. This is the number of shares. So according to these two numbers, our earnings per share is 2.51. That is meeting our goal. Not the goal, but initially this is the average earning per share. Now if we adjust, now impact on gross profit of changed revenue recognition, that is 27,000, that we are recognizing it sooner. So if we reduce this 27,000 and come up with an adjusted net income, so our earnings per share falls down to 2.49. Now over here, the motivation is that there is a desire to meet or exceed the average of analyst forecast earning per share, and exactly this is what has happened. Now if we deduct 27,000, we're going to get earnings per share that is less than 2.5. And again, the disciplining mechanism would be to include auditors, market regulators, financial analysts, and financial journalists. Example 5. Example 5 is a long-winded question, and the topic is misuse and misreporting of non-GAAP measures. Now over here, Groupon is an online discount merchant, and the main problem over here is that they have this online marketing expense. That is an online marketing expense, and what they are doing, they are adding it back to their operations, income from operations. And the reason why they are adding it back is because they believe that it does not have it's not recurring. And let's read this whole case together. But the crust is that the major problem is with this online marketing. Now, Groupon is an online discount merchant. In the company's initial S1 registration statement in 2011, the CEO Andrew Mason gave prospective investors an upfront warning in a section entitled "We don't measure ourselves in conventional ways," which describes Groupon's adjusted consolidated segment operating income, that is CSOI. Exhibit 12 provides excerpt from a section titled Non-GAAP Financial Measures, which offered a more detailed explanation. Exhibit 13, also from the initial institution statement, shows a reconciliation of a CSOI, that is our operating income, to the most comparable US GAAP measure. In this review, the SEC took the position that the online marketing expense were recurring cost of business. On the other hand, Groupon responded that the marketing costs were similar to acquisition costs and not recurring cost. Now, this is the main difference over here, that the company doesn't believe that the marketing cost is recurring, but on the other hand, SEC says that it is recurring cost. And if we go and look, the online marketing expense has been there for the past 3 years, so it is recurring, and it needs to be accounted for. Eventually, and after much negative publicity, Groupon changed its non-GAAP measure. Now, what happened was that they were reporting this adjusted operating income, and they were adding all of these three expenses, especially they were adding online marketing expense. Now let's read. Now, eventually, and after much negative publicity, Groupon changed its non-GAAP measure. Exhibit 14 shows an excerpt from final prospect filed in November. Now, in Exhibit 14, they are showing that they are adding stock-based compensation and acquisition related, but over here they are not adding marketing expense back to loss from operation. Now, if we look at Exhibit 13, when they add back online marketing expense back to losses from their operation, now what is happening when they add the online marketing expense back? Operating income actually becomes positive. Now, adjusted CSOI is operating income for our two segments, North America International, adjusted for online marketing expense, acquisition related cost, and stock-based compensation expense. Online marketing expense primarily represent the cost to acquire new subscribers and is dictated by the amount of growth we wish to pursue. Now, this is again quite important. Adjusted operating income to be an important measure of the performance of our business, as it excludes expenses that are not non-cash or otherwise not indicative of future operating expenses. We believe it is important to view adjusted operating income as a complement to our entire consolidated statement of operations. So in isolation, we shouldn't be looking at operating income. Our use of adjusted operating income has limitation as an analytical tool, and you should not consider this measure in isolation or as substitute for analysis of our result as reported under GAAP. Some of these limitations are, now these are the limitations over here. For example, adjusted operating income does not reflect the significant cash investment that we currently are making to acquire new subscribers. And maybe one more, adjusted operating income does not reflect any foreign gain and losses. Now, because of these limitations, adjusted operating income should not be considered as a measure of discretionary cash available to us to invest in the growth of our business. When evaluating our performance, you should consider adjusted operating income alongside other financial performance measures, including various cash flow metrics. net loss, and our other GAAP results. Now the first part is, what caution did Groupon include along with the description of adjusted operating income metric? And again, as we have just mentioned, the Groupon cautioned that the adjusted operating income metric should not be considered in isolation, as we have just discussed, should not be considered as a substitute for analysis using GAAP result, and should not be considered a measure of discretionary cash flow. And the company lists numerous limitations, primarily citing items that adjusted operating income did not affect. Now, the second part is, Groupon exclude online marketing from adjusted operating income. How does the exclusion of this expense compared with SEC limit on non-GAAP performance measures? As we have just seen that when we add online marketing expense back, it increases our operating income, and from negative it becomes positive. The SEC specifies that non-GAAP measures should not eliminate item tagged as non-recurring, infrequent, or unusual when such items may be very likely to occur again. Now over here there was this dilemma that the company was considering online expense as non-recurring, but SEC regarded it as recurring because it was again it was frequent. The last 3 years there was this marketing expense and it was recurring and it was not non-recurring. Because the online marketing expense occurred every period reported and is likely to occur again, exclusion of this item appear contrary to SEC requirement. Part 3. In the first quarter of 2011, what was the effect of excluding online marketing expense on calculation of adjusted operating income? If you go back in 2011, the first quarter, when we add back our online marketing expense, it makes adjusted operating income positive. And furthermore, 3 months of 2011, only 3 months, the operating income was 35% higher than the whole 2010 year's operating income. As shown in Exhibit 30, in the first quarter of 2011, the exclusion of online marketing expense was enough to swing the companies from a net loss under US GAAP reporting to a profit. At least a profit as defined by adjusted operating income. Using adjusted operating income as a performance measure, the company showed results that were 35% higher from the first quarter of 2011 compared with the entire previous year of 2010. And this is exactly what we discussed. For 2010, how did the result under the revised non-GAAP metric compare with the original reported metric? In Exhibit 14, we revised, and now we are not adding our online marketing expense back. So if we don't add our online marketing expense back, so our loss is 180,993 million. And if we were adding it back, we had actually a gain of 60,553 million. So as shown in Exhibit 14, the revised metric is now called CSOI and no longer refers to adjusted CSOI. For 2010 result under the revised non-GAAP metric, which includes online marketing cost, shows a loss of 180 million instead of profit of 60 million. Example 6, effect of cost flow assumption. A company starts operation with no inventory at the beginning of a fiscal year and makes purchases of a good for resale 5 times during the period at increasing prices. Each purchase is for the same number of units of the good. The purchases and the cost of goods available for sale appear in the following table. Notice that the price per unit has increased by 140%. From $100 it has gone up to $240 by the end of the period. During the period, the company sells $250 each, all of the goods purchased except for 5 of them. So this is our ending inventory. Although the ending inventory consists of 5 units, the cost attached to those units can vary greatly. Now we know that the prices are rising. What are the ending inventory and cost of goods sold if the company uses FIFO method of inventory or costing? So in FIFO, first in, first out, our cost of goods sold is lower than inventory. In LIFO, the cost of goods sold is high and inventory is low. But we are again looking at first in, first out. Why inventory is higher? Because In first in first out, the ending amount or the ending balance would be the one which has higher cost. Now over here, what do you think would be the inventory? First in first out, so we are left with 5 units, and now first in first out, the ending inventory would be part of this $250 purchase that we did. So 5 into 240 is equal to 1200. So 1200 is our inventory. And what will be our cost of goods sold? So cost of goods sold, the total cost of goods available for sale is 4350. So this is our total cost. So 4350 minus 1200 would be 3150. What are the ending inventory and cost of goods sold if the company uses the weighted average method of inventory costing? So again, if their prices are rising, this is first in first out, so ending inventory would be higher, cost of goods sold would be lower as compared to LIFO. So LIFO's cost of goods sold is higher and inventory is lower. So if we are going from FIFO to weighted average, so we are going in between, so ending inventory would decrease and cost of goods sold would increase. So initially in FIFO, cost of goods sold was 1200, and first in first out, ending inventory was 1200 and cost of goods sold was 3150. So in weighted average, the average cost would be 4350 divided by 1, 2, 3, 4, 5. So we have 25 units divided by 25. So 4350 into divided by 5. 4350 divided by 25 equals to 174. So each unit is of $174, and the ending inventory is 5 units. So 5 into 174 equals to 870. So ending inventory has gone down from 1200 to 870, and the cost of goods sold would increase. So the total cost of goods sold was available for sale was 4350. So 4350 minus 870 equals to 3480. So cost of goods sold has gone up from 3150 to 3480, and ending inventory has gone down to 870 from 1200. Compare cost of goods sold and gross profit calculated under the two methods. Now, as we can see, in first in first out, ending inventory is higher and cost of goods sold is lower. When you go towards weighted average, cost of goods sold increases and ending inventory goes down in weighted average. So when cost of goods sold goes up, the profitability will come down, and this can be seen over here that the gross profit margin is highest in FIFO and it falls in weighted average. Now sales 5,000. Now cost of goods sold was 3150 in first out, but 3480 in weighted average, and because of this the gross profit changes and hence the gross profit margin. So one thing for sure, if we go from first in to weighted average, cost of goods sold will increase and ending inventory would go down. So again, if cost of goods sold increases, this will going to pull down the gross profit. If this was last in first out, in last in first out, cost of goods sold is higher and ending inventory is lower. And if you are going towards weighted average, so cost of goods sold will go down and ending inventory will increase. So if cost of goods sold decreases, gross profit will going to go up. So from LIFO to weighted average, gross profit will increase. Depending on which of the cost flow assumption the company uses, the end of period inventory is either 870 or 1200. Now the choice of method resulted in the difference of $330 in gross profit and 6.6% in gross profit margin, which we observed over here.